Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets. You know what really is not making sense to me right now? Some of the economic data. I mean, markets haven't been making sense to me for a while. Some of you already know that. That's not a surprise. But there's something in the economic data that's bugging me. And I want to walk you through that today as we go through the data. And I'll set it up for you so you can kind of see as we go through. It just, something's not adding up right. And it doesn't mean that I'm interpreting it wrong. I could be. That's always a potential, when you're looking at data to say, well, am I missing something? Or maybe something is missing and it just needs more time to play out. Or maybe I need to, spend some more time thinking it through to see, what angle I'm missing. So we're going to look, I'll set that up before we go through everything. We've got economic data to go through. We've got the credit data, the H.8. It's still nothing good there. I mean, if we're looking for reflation, we're certainly not going to see it there. We've got a chart from Stefan to take a look at. We'll preview the commitment of traders report. As you know, we go through that on Monday. It is released on Fridays. Our friend Brent Johnson has already sent us some charts. Stefan has sent us some charts before the show for Monday, so we'll kind of preview what's going on in the bond market. So here's a conundrum, or here's what I'm struggling with. We had this increase in the M2 last week, which we'll go through, so you'll see it. It tells me that stimulus checks are finally hitting bank accounts. Where they're hitting the bank accounts is also somewhat odd, at least that I'm finding odd. You have the factory sector, which is go, 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 right? I mean, all of a sudden we're seeing, prices paid up. We're seeing orders up. We're seeing inventories rising as if the factory sectors are going crazy about all this demand that everyone's talking about, this pent-up demand. They're getting ready for it. And then you look at the Red Book same-store weekly retail sales, which we looked at already on Wednesday. And we'll need to go back to that. And then you go like, well, wait a minute, this is not all connecting right, because if the money supply is rising, right, and you see the factory data rising, is saying, hey, look, there's going to be a lot of spending, and in the same week, there was just kind of a nothing burger on the Red Book retail sales. I mean, in fact, it was pretty much unchanged from the week before. It doesn't make a lot of sense. And this is trying to get inside the mind of the consumer. Where is everybody at right now? Are we seeing a trend change because people are being, having to pay on their mortgages or pay rent or other bills that are, no longer able to be in deferment? Or and then we add in the unemployment data. So something out that's another thing that let's just get into it and you'll see. No point and rambling. Let's go back to Wednesday after market close, and let's see if there's anything of great interest here. And there isn't. We'll move into Thursday. Italian industrial new orders up 5.3%. And meanwhile, Europe is kind of shutting down, going back into lockdown. But you can see in November, the new orders were up. Industrial sales in Italy, although went down minus 4.6% on a year-over-year basis. So that's kind of weird. So a lot of new orders, but sales are down. I imagine that'll work itself out in the next couple months worth of data. Let's see what else we've got here in the data. Going to Thursday, building permits up. Now this, in my opinion, Thursday pre-markets, those of you who are watching the bond market like I do know, it's like, hey, it was looking pretty decent overnight, and then all of a sudden, wham, 30 minutes, this thing, bond futures just got slammed. And I think it was on building permits, because what you're seeing is a lot of optimism from builders. I think permits are somewhere up near their 2006 level. This is, if you build it, will they come? The question that I have, at what point is this demand for homes gone, and are builders overextending themselves? And so far they haven't, but this is what moved the bond market, in my opinion, on Thursday. Housing starts also up 1.7, almost 1.7 million, up 5.8% month over month. December, so you had big building permits, big housing starts, a lot of optimism. And you have to think, now, why would that relate to interest rates? Well, what kind of loan do most people get when they buy a home? 30-year, right? So the market says, hey, look, there's all this demand for housing. And the computer algorithms say, well, that means interest rates need to go up because there's going to be a lot of demand for loans, and we're going to front run that. So that was my take on that. Now let's get into the jobless claims, and then we'll get into the Philadelphia Fed. So here's something I'm struggling with in this data here. So we see there's 900,000 claims, which is terrible. This is absolutely horrible. Now, one thing that happens after December, because there's usually a fair amount of hiring, right, in the holiday season, October through December, as businesses ramp up for the holiday season. Now we know that there wasn't a big ramp this year because, well, it should be obvious by now if you're not sure. And so what happens going in January is, sure, there's going to be people that lose their jobs. And what's the other factor is there's going to be people who keep their jobs because their employers are like, hey, this is a really good employee. We don't want to get rid of them, and we'll keep them on the books. All of a sudden, we've had, back-to-back 900,000 job losses. And someone went out on Twitter, and I think they're absolutely right, is a lot of these states push their minimum wage up to $15 an hour. Now, obviously, there's talk from the Biden administration that they'll make the base federal minimum wage of 15. That not really overly relevant. A lot of states raise their minimum wage. And one of the views I had is if businesses are struggling, and you've heard me mention this, that maybe they'll lay off some people. So this is a pretty big number still. I mean, it's up. Of course, it's down from the prior week of 926, but still 900,000 is a big number. Now, here's what's weird to me. When we look at the pandemic unemployment assistance, you remember this was in the 20 to 22 million, and now we're down to 16. So we're running almost 1 million people making new claims, and yet we're seeing almost 3 million people drop off pandemic unemployment insurance. Now, I went back and looked because I wasn't sure how long this lasts. It's 39 months, typical state insurance. Unemployment insurance, if you add them together, you get 52 weeks. Well, this is January data. So what's going on here? Why are we seeing all these people fall off the pandemic claims, but we're seeing also layoffs? Is there a rotation? Some people are getting their jobs back and other people are losing? And that doesn't make a lot of sense. So my view, which is supported by absolutely nothing other than my opinion at the moment, is perhaps there were people that lost their job, thought they were going to go back to work, or realizing they're not, and are actually retiring and drawing their Social Security benefits or pensions, and they're falling off the pandemic assistance. I don't have any way to support that view. It just seems strange because if the total benefits are 52 weeks, then there should be people staying on the PUA all the way, into sometime in March when they may have first lost their job, or even longer. So there's something that doesn't make sense to me there. Let's go on to the Philly Fed data. Now, the Philadelphia Fed Manufacturing Index, this is a good report. If you want to see what a good manufacturing report looks like, this is it. And so we're going to go to the Philadelphia Fed website. I pulled up the PDF on this. And this reads differently than the ISM reports, which is, I wish there was a standard, the Fed and the ISM and market were all standardized. They're not. And the way you read this is the percentage of firms increased, percentage firms decreased, and then it does the math to tell you what the net changes. So if we look at this report, it's outstanding. So whatever's going on in Philadelphia, it's looking pretty good. You look at the questions, general business activity, plus 26.5%. New orders up 30%. Shipments 22.7%. Unfilled orders going up 25.6%. What are you seeing? Backlog in the system. Delivery times. Now, that's not a surprise because we know there's supply chain issues and transportation. That's up 30%. Inventories still rising 12%. Potential problem, I think, is coming in the inventories. I think we're going to see too much of an inventory bill, because the manufacturing sector is anticipating something that I'm not sure is coming. Prices paid. And this is where everyone gets excited. Oh, inflation. Prices paid up 45%. So 45% of firms said prices were rising. Prices received up 36%. Number of employees up 22%. Now, again, this is firms reporting, not that the average firm added 22% employees. This is firms reporting an increase in employees. Average work week plus 18 So 18% of firms reported an increase. So this is a pretty solid report. And if you look at the special questions, and these are interesting, they don't always have these, but they are interesting. Over the past several months, how would you characterize the underlying demand for your manufactured products? Almost 64% reported an increase. How about in the next one? How will your firm's total production for the first quarter of 2021 compare with the last quarter of 2020? Almost 70%. Expecting an increase. That's huge. And number 3, if you expect increased production in the next quarter, this will be accomplished by 51% of firms said they're going to hire. So you look at this report and you go like, wow, like this is pretty good. So whatever's going on in the Philadelphia area, what you're seeing in the manufacturing sector, again, this is something I just not seen in the big picture because we're hearing this pent-up demand. And we'll go look at the retail sales data. We'll go back and look at that. So the manufacturing sector is saying, hey, we think there's a lot of demand. We got a lot of orders. We've got inventories building, and we think there's going to be a lot of demand. Now let's go back to the Red Book, same store weekly retail sales from Tuesday. Now, this is what I like this a lot because it's high frequency, meaning it comes out often. So every week we get new Red Book data year over year, up 2.2%. Last week, year over year was up 2.1. If you look at the underlying Red Book data, you can see that it's been up quite a bit more, up in the 5s and 7s and 8s. 2.2 doesn't tell me that there's a lot of demand, but the manufacturing sector is saying, yeah, there's going to be a ton of demand. Okay, well, we'll see. Because if it doesn't happen, now you got a massive inventory problem. There was a TIPS auction this week. I never really look at these. The reason I don't is because the Fed is pretty much buying 100% of what the dealers take every month in terms of dollar amount. Let's look at some of the preliminary PMI reports. Now, the way you read these is over 50 is an expansion. The further over 50, the greater the expansion. Under 50 is a contraction. The greater under 50 it is, the bigger the contraction. And right around 50 is no change. So Australia, manufacturing PMI, 55 to 57. So you're seeing an acceleration in the manufacturing sector there, looking pretty good in Australia as it gets better. The services PMI there expanded, but at a slower rate of 55.8 versus 57. Looking at Japan, manufacturing PMI, 49.7 means unchanged. Services PMI down slightly. The services sector in Japan has just been obliterated. It's not good. How about National Consumer Price Index in Japan, year-over-year basis, minus 1.2%. Deflation. Everyone thinks the U.S. is going to see hyperinflation or really high inflation because we're doing quantitative easing. This is a preview of what's to come. Japan's done QE and stimulus, and they got deflation. But America is going to somehow be different. How about Great Britain? Core retail sales, excluding food and energy, from 5.3 to 6.4%, so that's big. Looking at overall retail sales, 2.9%, plus 2.9%. It's pretty, missed expectations of 4, but it's in the plus. Back to these preliminary PMI numbers. How about on France manufacturing, almost unchanged at 51.5. The services sector in France contracted slightly, 46.5. How about Germany? The manufacturing PMI projected 57. That's a solid number. So 58 the prior month. So it's, the greater growth isn't as much, but it's still a nice number. Looking at the services sector in Germany, you're seeing a slight contraction at 46.8. So you kind of get the tone that either manufacturing sector is reviving, coming back so far, and the services sector is not. The service sector is going to be a problem because if you don't have people out making money to spend on goods and services, well, then you're going to have an inventory problem. How about the manufacturing PMI in Europe preliminary, 54.7? So slight expansion there. It's the rate of expansion is slowing overall. And the services is in a bit of contraction at 45. So we see services sector contracting broadly in the in Eurozone, the manufacturer sector expanding a bit. Overall, I think the services sector is going to kind of lead the manufacturing sector here. Again, if you build it but no one can buy it, what good is it? How about Great Britain manufacturing PMI into slight expansion at 52.9, slowing down bigly from 57.5. And look at the services sector, 49 to 38. So it went from unchanged the month before to 38.8. That is contraction. Why is that? Well, the economy shut down there. Looking at the U.S., we have now the market manufacturing PMI, a nice hot number, 59. So here again, the U.S. manufacturing sector is saying, hey, we see growth. We have demand from orders and coming in. We can't fill the ones we have, and we can't get the stuff to the stores. That was showing an increase in the manufacturing sector here. And same with the services sector. In the U.S., 54.8 to 57.5. So even a decent expansion here in the services sector, where the rest of the world is going the other way due to lockdowns, which could be coming here again. We'll see existing home sales up 0.7% in December. And then we have the crude oil inventory data, 4.35 million barrels. And what the market was really hoping for was a decline in gas inventories. They got it, even though they were projecting a big increase. So the market liked that. And distillate stocks fell underneath its expectation of 458,000 barrels. I still think we're going to have a supply issue here in the oil market, although everyone is bullish on crude. Now let's get into the money supply, because you've got kind of the picture, right? You've got manufacturing sector saying there's a lot of growth coming. Outside the U.S., the services sectors are contracting, likely to come to the U.S. too if we don't get this thing under control again. At least that's my expectation. You've got unemployment numbers rising, so people are not going to have as much money to spend. And then the retail sales are saying, look, people aren't outspending, even though the manufacturing sector is saying they're going to. Now here's the M2. Now remember, it's been kind of flattish for several weeks now. Look at the increase, right? So this would tell me there's stimulus checks going out, because it went up like 315 billion, and that's a pretty big jump in the money supply for 1 week. But what's interesting to me is when you look under the covers. Now you would think, where are these checks going to go when the IRS refunds them? It's going to go to people's checking account, right? I mean, when you pay your taxes, you pay it out of your checking account. So if they're going to refund you by the same method, or when people get their direct deposit back, they tend to have it go to the checking account. Look where the M2 is at. It's in savings. So people bolstered their savings accounts. Demand deposits were virtually unchanged. And institutional money funds only up slightly, as it looks like there's a little more cash went into brokerage accounts. It all went into savings. So what is that telling you about consumer expectations? They're banking money. If they're going to spend it, you think it might show up in demand deposits. So did it hit demand deposits and did they all shift it into savings? See how I'm saying the same thing? This just doesn't quite add up to me. Let's look at the H.8 data. Bank credit contracted 10 billion. Securities and bank credit were up just a slight 6 billion. Mortgage-backed securities down 8 billion. Where are you, mortgage-backed securities? Oh, up here. Mortgage-backed securities down 8. U.S. Treasuries. This is kind of the first time we've really seen an increase in. Well, we have seen a couple, but it's not much of increases. So now we're at 1.22 trillion in Treasury securities, but not a big ramp there. Loans and leases, all commercial banks, down 16 billion. Commercial industrial lending continues to slide at minus 15 billion. Residential real estate only up $1 billion, despite massive amounts of people taking out loans, buying homes, and doing refinances. Commercial real estate is up $1 billion. This still baffles me. I'm only wondering if banks are not foreclosing on commercial real estate, because we know there's a lot of empty or partially filled commercial real estate out there. How about consumer loans? Everyone, again, is looking to the consumer as pent-up demand, and pent-up demand is equal to a 5 billion contraction in consumer loans as they pay off their debt. So credit cards down, 3 billion. Other loans were down a couple billion. Consumers are deleveraging, which is not an indication of future demand. Let's look at the PowerPoints here. We've got the M2 money supply 12-month rate of change is staggering 27% and rising. The 6-month rate of change is now back rising 6.7%. 3-month rate of change is 3.9 and rising. Let's look at the year over year on some of these other charts. We've got real estate loan growth. Now this is up. It's not up because of residential real estate. Residential real estate is contracting. This is only holding itself together because of commercial real estate. So the growth rate is up 1.15% from a year ago. 6-month rate of change is up to minus 0.23%. And the 3-month rate of change is up to minus 0.16%. But at the rate of residential real estate slowing, this is likely to go negative. And if there's ever any defaults in the commercial real estate space, which I expect there will be lots, this thing will go negative quick. Commercial industrial loans continues to slide, will likely go negative on a year-over-year basis in March. Growth rate is down to down to 9.5% from a year ago. But look at the 6-month rate of change, almost at minus 10. 3-month rate of change is at minus 4.62. So total loans and leases and bank credit. Here again, you're looking for inflation. You're looking for money creation. This is not where you see it. Growth rate is down to 3.18% from a year ago. Possibly will contract in March if commercial industrial lending does what I think it's going to do. 6-month rate of change is at minus 2.39% and falling. 3-month rate of change is at minus 1% and falling. And here's the consumer. You talk about credit cards and growth. It's down to 12.2% from a year ago. Consumers are deleveraging. There's your no V-shaped recovery, no inflation in that. All right, let's see. We've got a couple other charts here for you. This one from Stefan. He wanted me to point out in today's show. This is TNX, and I do want to talk about the quant computers or CTAs briefly too. Again, for anyone who didn't fully grasp it on Wednesday's show, but he said look at the commercial positioning on the 10-year. He said it went way up. Now, normally you see a mirror version on the non-commercial. He believes that this is a sign that commercials are getting prepared to take advantage of a big move lower in interest rates. If we look at the commitment traders, I think we'll come back to that for Monday. And this was from Northman Trader. He posted this on Twitter. Percent of the S&P 500 over its 200-day moving average is 92.2%. That is ridiculously high, signaling potential reversal in the equity market. Let's look at that CTA positioning on the 10-year. So I did the math on this, and I mentioned this on Wednesday, but let's kind of just review it again. Should 10-year Treasury yields get right back down to here, which in bond prices is around 0.6% move higher on the 10-year bond, then the CTAs are hit a buy signal. I don't know if the buy signal is they go from they're slightly net short just to neutral, or we kick into a long position. In order for the CTAs to continue shorting, then Treasury yields have to go up by 6%. Not to 6%, but it's got to go up 6%. Not likely to happen. Looking at TLT, the same thing. I said you're looking at them buying back in right here before the Georgia runoff Senate elections. And in order for them to go shorter, their price here has to go way down. Volume on TLT has really dropped off. It's kind of signaling to me that the sellers are pretty much going away. We know the big sellers, the CTAs, are gone, and this tells us there's not much selling activity. But if you're looking for some sort of confirmation that this is the bottom, well, wait a week or two and you'll probably see a much cleaner picture of what's going on when prices come back up here. And what show will be a show without the dollar, and the dollar is trying to form another bottom here. Will this be it, or is this just another consolidation pattern before a move lower? Well, we'll find out probably soon enough. Well, again, I'm Steve Van Meter. I appreciate you taking time to watch. Appreciate you being fans, doing the subscribe thing, the like thing. You know, you all mean the world to me. You really do. I wouldn't do the show if it wasn't for you. So I appreciate your support, and we'll be back on Monday with all that commitment to trader stuff and what other economic news finds its way for us to talk about. And I'm sure we'll talk about, that's right, the bond market, because how can we not do, well, boy, someone's going to rate me on my inability to put my crown on while looking at myself in the screen. Have a great weekend. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategies. It was prepared by Steve Van Meter. Personal capacity opinions expressed this video that do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.